Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. Thanks for Policy Genius for sponsoring this video, but more on that later. So this video is going to be about where you should park your money when you're saving for either a house or some sort of long-term purchase. Actually, I shouldn't say long-term because depending on the person's time frame, that's actually going to alter my financial advice. But like all YouTubers, this is not financial advice. I'm just the guy on YouTube, yada, yada, yada. So anyway, what I'm going to do is I'm going to base this example off someone from Reddit. I'm not going to read this entire post verbatim, but basically you need to understand that this is a couple in their 30s, and between his wife and himself, they earn about $170,000 annually, and they're looking to save up for a house sometime by next summer. So they're looking to save a solid down payment, which you can see here highlighted in green. They will be first-time home buyers looking in the $450,000 to $500,000 range. So right now they have about $120,000 in cash in their savings and checking account, which is basically uninvested, and they have another $50,000 basically sitting in large cap and S&P 500 index funds. So he was running some numbers, and he was saying that they should easily be able to save another $70,000 over the next 10 months. So his main question here in orange is, should I invest more in our brokerage account to grow our down payment for summer of 2022, or should I just invest this money, or should I keep it in cash? So none of them have any debt or student loans, which is great. And then down here highlighted in red, which also changes certain advice, is that they're also trying to start a family soon. So just by understanding this scenario, like I said, I get asked this to me a lot of the time, and it all boils down to what you want to save for and also what your time frame is. So I'm going to give that advice at the end of the video. But first, let's go into CPI, because this is going to dictate a lot of people's strategy and a lot of people's thinking. So if you don't know what CPI is, this basically is the Consumer Price Index. It's basically trying to aggregate and trying to understand what the annual inflation rate is based on all these consumer items, which you can see here. You have food at home, energy, electricity, gasoline, etc., etc. Basically, how much have prices gone up or down with basic living needs being fulfilled, if you will. So you can see here that right now, in June of 2021, we're sitting at 5.4%. So keep this number in mind. It's the highest rate of inflation since July of 2008, since the last recession, okay? So keep this number 5.4% in your mind. So what I did was I wanted to break this down in a couple of different items that this person can save in and invest in. So obviously everyone's strategies are going to be different. Sometimes you have people on Wall Street bets betting $50,000 on GameStop options. Sometimes you have people saving their money in a CD, okay, which is locking their money away essentially. So I'm not going to go the GameStop route, but what I will show you here is, let's start with CDs. So what are CDs? These are certificates of deposit. You basically lock up your money for a certain given amount of time. You can see here that these are all 5-year terms in exchange for a certain return, okay? So if I went to, let's use Pentagon Federal Credit Union right here, okay, as an example. If I locked up that 120 grand that this person was talking about here, and another, let's say, 70K over the next 10 months. Let's just say I have 190 to plop down into this CD. Well, I'm going to be locking up my 190 for 5 years, okay? So already this is a no-go, because this person is talking about that they want to lock up their money or invest for a year and try to buy in summer of 2022. So even if this person was locking this money up for 5 years and was looking to purchase 5 years from now, they're going to be making 1.1% on that $190,000, okay, if they've put away the 120 plus the 70. So remember, guys, we just found out that the rate of inflation is 5.4% for the month of June, and 5% in the month of May, 4.2% in April, et cetera, et cetera, et cetera. Typically, it's anywhere from, I'd say, 1 to 3%. The Fed tries to shoot for 2%. So keep that in mind. So just by locking your money away in this Pentagon Federal Credit Union CD, you are basically losing 4.5% every year to inflation if it stays at that 5.4% roughly. Okay, so just know that the cost of everything, your purchasing power, is literally being deteriorated. That's why I have many videos on savers are losers. Okay, there's a reason for that. So let's have a quick little laugh here, and let's go down to much smaller terms, let's say the term is a year and a half from now, okay? This person would be locking his money up, all the opportunity cost that comes with that, for 0.7%. So basically losing 4.8% or so of his money in purchasing power month over month if that CPI stays consistent. Literally losing purchasing power, okay? So CDs, I'm going to rule this out, right? So let's go to the next logical liquid thing that you can put your money in, which is a high yield savings account. So here we are earning 0.5% at Marcus by Goldman Sachs, 0.5% with Citi, 0.56% with Biobank, I don't know who that is, 0.55% with Comenity Direct, don't know who that is, et cetera, et cetera, et cetera. So it's safe to say that we're looking at 0.5%. So let's just call this, if inflation is, let's just say 5.4%, we're looking at 4.9% in purchasing power being lost by keeping our money in a savings account, okay? However, this is where the advice kind of starts to come in. Actually, before I get into the advice, let's look at our third option real quick, and let me just fly through this. You can say, hey, Marco, you can invest in a, total stock market index fund or an S&P 500 fund, like VOO from Vanguard, for example, or SPY. So if we take a look at the S&P 500, you can see right here over the past year, it's already returned 33.09%. Okay, if you compare that to the CD of 0.7 for a year and a half, and you compare that to a liquid bank account, which is FDIC insured, by the way, up to $250,000 per account, you're looking at a much higher gain, okay? However, that's over the course of a year. Let's look at year to date, 19.8%, 6 months, 13.29%, 1 month, 1%, 5 days, 0.5%, 1 day, 0.1%, right? That's not a realistic scenario, but I'm just trying to give you all options. If you look at the past 5 years, you've doubled your money if you just invested in an S&P 500 index fund. You are up 103% from basically August 12th, 2016, okay? And if you go max, S&P 500 is up 3,200% since essentially 1981, okay? However, what you need to realize is, and before I get into the advice and the whole point of this video, let's have a word from our sponsor, Policy Genius. If someone relies on your financial support, whether it's a child, aging parent, or even a business partner, you need life insurance. There's a feeling of comfort and, in my opinion, reduced stress in your life knowing that your loved ones are covered in the event of something happening to you. Policy Genius makes it easy to compare quotes from over a dozen top insurers all in one place. You could save 50% or more on life insurance by comparing quotes with Policy Genius, and you could save $1,300 or more per year on life insurance by using Policy Genius to compare policies. Getting started is easy. First, head to policygenius.com/whiteboardfinance. In minutes, you can work out how much life insurance coverage you need and compare personalized quotes to find your best price. And when you're ready to apply, the Policy Genius team will handle the paperwork and scheduling for free. Policy Genius never sells your information to other companies, and they don't add on extra fees. The licensed experts at Policy Genius work for you, not the insurance companies, so you can trust them to help you navigate every step of the shopping and buying process. Head to policygenius.com/whiteboardfinance to get started right now. All right, so let's resume where we left off talking about the S&P 500. So if this person were to put all of his money, let's say that $190,000 over the next 10 months into the S&P 500, we have to take a realistic look at what markets do and their longest bear markets and recoveries. So if you look at this chart here by Investopedia, you can see in the dark blue, this is the length of bear market in months. So on the y-axis, you can see here 60 months in the top left. The light blue is the S&P 500 decline percentage, meaning how much the S&P went down. And then you can see the length of recovery in months in yellow. So if we just go down here, I'll show you all the way at the end. I'm going to start right here just because this is what most people are familiar with. You have the Great Recession of 2007, 2008. Then you have February of 2020, okay, when the market took a big dip because of the cerveza sickness. So if we look at 2008, you can see in dark blue, the length of the bear market in months was 17 months, okay? So say a bear market started tomorrow. This person wouldn't be able to buy a house for 17 months, and the decline that the market went through was 56%, okay? Imagine losing 56% of your portfolio. So if you put in, let's say $200,000, you're sitting at less than $100,000 17 months later. And it took the market 49 months after that to recover in yellow right here. Now, if we looked at March of 2020 or February of 2020, when everything went down because of the pandemic, lasted 1 month, entire portfolio went down 34%, which we can see right here, and it took 5 months to recover. But yes, the recovery was insane. If you just look at, let me go to 5 years. This was basically March 20th, 2020. And then you can see the recovery almost, well, it did double, but you can see how steeply this went up, and that's due to a lot of money printing. But anyway, my point is that if you went the 100% equities route or the 100% stock market route, you need to be able to realize that, hey, these downturns or these bear markets, they last more than a month most of the time, okay? So depending on your time frame, this is the whole point of the video, this really dictates everything. So my personal opinion, it matters what the purchase is for, and it matters when the time frame is. So let's start with what the purchase is for. If you told me, hey, Marco, I want to buy my third yacht or my second Lamborghini, my third Ferrari, I want to do it within 1 year. Where should I put my money? Well, that's different than saving for a house. So a house is a primary residence, and if you remember, this gentleman said that he wanted to start a family soon, which makes it even more important for this residence to be secured. That way they have a stable household for these kids to be raised in, okay, knock on wood. So with that being said, time frame is second. Now, anything that's less than 3 to 5 years, in my personal opinion, typically less than 5 years preferably, that needs to be in a high-yield savings account. A, because it's liquid. B, because there are no fluctuations in that cash. The only time that's going to change is if you get, fraud or hacked or whatever. But even then, again, you still have FDIC insurance, or you spend that money for something else. You don't have the discipline to keep it in that account. Yes, you're going to lose a lot of purchasing power to inflation, especially with all the money printing that we've seen over the past 18 months or so. But at the same time, that money is going to be there for the down payment in summer of 2022 in this gentleman's case. Now, if his time frame was 5 years or more, let's say he wanted to save for a forever home 10 to 15 years from now, then it makes all the sense in the world to put that money into an ETF or an index fund and just ride the market for the next 10, 15 years whenever you're ready to buy that forever home. Now, some people may be saying, hey, Marco, you're not Dave Ramsey. Hey, Marco, you're not Wall Street Bets YOLO Chicken Tendies, betting the entire farm on options that expire in 2 months from now, not even. So you could also be somewhere in the middle. You could invest maybe a half of that 190 or maybe a third of it or maybe 20% of it in the market and then keep the rest in that quote-unquote high-yield savings account. In my personal opinion, I wouldn't even be greedy or play those games. It's not even worth it at that point for a primary residence. But if it's for an investment property or something else where you're not going to live in it, then maybe that hybrid scenario would make more sense. So with all that being said, if the time frame is 5 years or less, keep it in a high-yield savings account. 3 to 5 years, I guess you could say that, depending on your risk tolerance. If you want to go hybrid, you can do a little bit in the market, keep the rest in high-yield savings. Third option is just YOLO Wall Street Bets, put everything on options and GameStop. No, I'm just kidding. You can put everything in an index fund and just kind of cross your fingers at that point. So I hope this video was helpful for you. Thank you for watching the sponsors that I do have on this channel. I don't really sell anything on this channel. They are the ones that keep the lights on, and I appreciate you guys sitting through that. Please like the video. Please share it with a friend who may be saving for a down payment. And as always, have a prosperous day. If I had that 120, let's see what this guy is doing right here. Hold on. Let's see. You got 120. They're saving $850 a month. I'm able to save another $70K over the next 10 months. Okay, let's see what we're doing here. Let me go to Robinhood real quick. I'm going to open this up. Let me go to GameStop. Okay. Little GameStop action, trade GME options. Let's see what these calls are going for. I'm going to buy a call expiring. So today is August 13th. Let me do a 3-day option. Sounds reasonable. Let's do a 3-day option. Okay. Right now, share price is at 159. This thing's going to the moon, baby. I'm buying out of the money, 180s. Continue. Let's buy 10 of these things. Oh, screw it. Let's bet the whole farm. Let's buy 1,000 of them. 88 grand. Let's go, baby. Okay. No. See you guys.